In today's video, I'm going to teach you how to improve your strike rate. This is for any strategy out there, not just our strategy, because this is based on the market location, trading at high probability and low probability locations. So I'm going to show you with examples, the setups and the ways that you can look to get involved and improve your strike rate. Our Trading Missing Pieces course is now complete. That is a full price action course. If you want to get access to that, visit our website down in the description of this video and see also what you get access to. If you wanted to join our Diamond program, which is going to fast track your way to consistency, go through the mentorship, go through our roadmap step by step, put in the work, and we will mentor you completely free. Me and Chucks do this every other week for our traders. So if you're at a stage where you're break even or you're just into profit, we're going to make you a consistently profitable trader, and we do that completely free, all for the traders in our mentorship that put in the work and put in the effort and put in the time. Over a quarter of our small community is already consistently profitable, and that is saying a lot in this industry where most traders are inconsistent. So we really put our emphasis on that Diamond program and making sure that we're mentoring our traders completely free into consistent profitable traders. That is our goal here in NJAT. We do have bigger goals for all of those Diamond members as well, to trade a very large fund, but to get there we have to make sure that we have a certain amount of profitable traders and consistent profitable traders as well. So let's get into today's video and today's topic. There's a very important reason why these trades are marked as low probability trades and these trades are marked as high probability trades. There's a clear difference in both of these trades. So let's just start over at our annotation, which I've created over here. So this is a probability scale based on structure, based on where you're executing your trades. This is selling setups and buying setups. These are exactly the same setups, but depending on whether you're looking for a buy or a sell, which is obviously based on the higher time frame. So you can use RAMC, which is range initiation here. If this is a higher time frame setup here, let's say like a monthly, weekly, daily, 12-hour range in initiation, when price pulls back into this sideways range here in the future, you can go onto a 15-minute chart or a 1-minute chart, and then you can look for these setups that are about to go through in a second here. This pattern already is high probability to react and see some sort of movement away from this previous sideways range. So if you can identify this on the left-hand side of the charts, then on the right-hand side of the charts, if you're finding that you're getting taken out of trades quite a lot of the time, then you need this second step, which is identifying high probability locations on the lower time frame. So this is step number one here. This is our higher time frame pattern that we're always looking for. So this is the first part of your process. Now, when we get into step two here, so this is at our points of mitigation. So let's say prices come into an area here that is a previous mitigation. So you know that you're looking for sells and you see this setup. This is where you're going to look for your entries here in this high probability location. So we need to understand the structure first. Of course, when price is trending here to the upside, we're going to be making higher highs and higher lows here. But what everyone says in a trending market structure is as long as we're bullish, then you want to be looking for buys. This is not correct if you want to get onto the right side of the market more often. You need to actually think about where the high probability and low probability locations are in a trend. We also obviously have a downtrend, so use exactly the same as what you're about to learn today and just apply it to the opposite direction. Then another market structure that we have is a sideways ranging market structure. This is what's called consolidation as well. So we also want to think about how we can trade this consolidation in high probability and low probability locations on the charts. So the purpose of today's video is I'm going to go over the structures in the market and I'm going to go over the scenarios and the setups, and then you can start to apply these setups alongside your entries. If you think about price in 3 steps, you've got number 1, which is your higher time frame analysis. You've got number 2, which is your lower time frame setup. So this is what we're about to go through today. This could be something like a 15-minute setup, for example. This is exactly what I look for on the 15-minute. And then number 3 is always going to be your entry, right? This is how you create a playbook in the market. Your higher time frame analysis is always going to be range initiation on the left, as we've been through in the previous videos. Here, range and initiation on the left. That's what you're always trying to identify. Then when we come back into this point of mitigation here in the future, I look for number 2, which is your setups, which we're about to go through. Then number 3, once you've identified your setups and you've identified your high probability location, that is when you're going to go to step number 3, which is your entry. Now, this entry is either going to be a 1-minute entry or a 15-minute entry. Or if you trade a different time frame, then obviously it's going to be a different time frame for your entry as well. If you want to learn mine and Chucks' entries, like the 1-minute and the 15-minute entries during the session where we know that there's likely to be a larger move happening, You can learn both of those by going to notjusttrade.com and enrolling, and you'll get access to everything, all our strategies and our price action course and the daily mentoring as well. So let's focus on step number 2, which is the lower time frame setup. So we know that every single point here that we see in market structure, these are always going to come from previous sideways ranges over to the left. Even this reaction here, a swing high, is always going to come from a previous sideways range and initiation to the downside. When price pulls back into this range here in the future, this is where we've reacted from here on the right-hand side of the charts. So now we just need to think about the setup and where is high probability within our setup in the market as well. Now, the lowest probability if we're looking for sell setups is always going to come in the continuation leg. So like I said, previous sideways ranges here over to the left, sideways range, initiation, mitigation, and now we're in the continuation leg, right? That's always going to target a swing high or a swing low. So anytime we see price running up into this location, if you're selling a continuation leg, this is going to be low probability. This is not a good setup to look to get involved in the charts. Now, when prices run this swing high into a sideways range over to the left here, and we've mitigated, now a lot of you are probably thinking, well, if price comes up into this area, how do I know when I sell? Well, this is the key here to understanding what to do in this location. We are looking for continuations from a previous mitigation. So we don't have to guess the area. We have to just identify when price starts to slow down here. And then we have to identify continuation structure away from this location. Then we can look to trade that in that direction. So the setup here is price running above a high into a mitigation and then going to your entry time frame and looking for continuation structure away from this location. That makes it a high probability setup in the market. Now, the best areas to look to trade that as the continuation down is any continuations down into this low that we have down here. These will all be high probability continuations because price is going to target a next low within the market. So that's the first setup for a sell continuation. Do not look to get involved in this continuation leg. Wait for price to get to the point of mitigation, see continuation away, and then you've just maximized your potential for taking profit on your trade. So that's the first setup. The second setup here is a sideways ranging setup. So again, same scenario, right? Price reacts from a previous sideways range here over to the left and initiation when price pulls back into this location here in the future. If we're looking for sells here, we are not going to sell at this high. If we're in a sideways range here, we're going to wait for price to run a high into the mitigation. And then again, we are looking for continuations away from this location. If you are looking to sell the market and price breaks a high like we see here, and we don't have any bearish continuation structure in the market, this is low probability trading because you're trading against the momentum within the market. It's always important to wait for price to slow down, create continuation structure in your direction of trading. Now you have two timeframes that are aligning together to play continuations there to the downside. So again, that's another setup that you can always look for. And it's really important to understand the setup, number one, but then number two is understanding continuation structure away from your higher timeframe mitigation. And then look for number three, which is your entry. And then you're going to get into a lot higher probability trades that are going to play out in your favor overall. Now, let's go into this bottom one here. So this is buying setups. This is also really important to understand in continuation structure. So price is always going to come from a previous sideways range over to the left. Again, that's always your higher time frame part, which is, let's just bring this over here. Higher time frame analysis is always looking for a sideways range initiation. Price pulls back into that sideways range here, and we get mitigation and continuation phase. That's a bullish order flow pattern to read direction within the market. So now we've got that. We're at that point of mitigation here. This is where you're going to look for your lower time frame setup, which is that continuation structure away again. So you go into the lower time frame like your 15 and you're looking for your continuation structure away. You have your higher time frame analysis. The lower time frame is also showing you continuation structure away. Then you can look for your entries. Now, this part is very important. Only play continuations before the breakout. Very, very important to only play them before the breakout. When you're starting to enter trades that are at the breakout or after the breakout, these are going to lower the probability of you catching a winner. So anywhere around this area, all the way into the high here, this is going to be low probability trading before the break or just on the break and then after the break. These are low probability trading locations you want to stay away from. So typically you want to be getting involved before the break there to the upside to maximize your profit potential on the trade. It's the same here. This is exactly the same setup. right? Let's just put the same thing here and drag that across. So again, if you're looking for buys, price have run above that high. This is actually going to become a sell setup now if we react from a sell mitigation, the same as the one that we had up here. Again, so you can just use this one that we have up here. We run into that mitigation, and this is bearish continuation structure. You do not want to trade against bearish continuation structure, and do not trade against the trend. This is going to be low probability continuations. Wait for price to get into a previous sideways range onto the left. Wait for bullish continuation structure, and now you're trading alongside the higher time frame trend and the lower time frame trend, and that is where you're going to get into those winning trades here to the upside. It's the same on the opposite side, right? So if you're getting a reaction here, and then we've seen a bullish continuation away from this mitigation, if you're trying to catch every single reaction here as price is in bullish continuation structure and you're trying to sell this, this again is going to be low probability trading. Trade with the continuation structure away from a higher time frame mitigation, and you'll always be on the right side of the market. Again, if you're in any trades here, you want to be looking to get into trades before price reaches the breakout. Anything after the breakout and continuation is going to be low probability trading. Yes, some of them might work out here to the upside, but overall, if you want to get yourself into high probability trades consistently, then get into trades before the breakout happens. And then this is a range setup here. Let's just move this across. We'll go through some examples in a second as well. But these are setups again. So if we're in a bearish trend here, we broke the low. So again, any continuations here will come from a previous sideways range, initiation, mitigation, continuation. You can play bearish continuation into the low. Before the low breaks is where you want to be getting into your sell continuations. If price breaks the low, these are going to be low probability trades here to the downside. So you don't want to be getting involved in those. If we run below a low, again, you want to be looking over to the left here. Where did price react from? Sideways range, initiation. If we pull back into this sideways range, this is the mitigation phase here, and then continuations here to the upside into the previous high that we have up here. These are going to be high probability trades. As long as you see bullish continuation structure, you can look to buy up into this high. Again, same scenario. If price comes into the breakout, these are low probability trades after the breakout or just before the breakout or on the breakout. So you don't want to look to trade those at all. Again, same here, right? If price is reacting from a previous sideways range that we have over here to the left, and you're seeing bearish continuation structure here to the downside, do not look to buy any of these opportunities. These are low probability trades because price is seeing bearish continuation structure from a higher time frame mitigation. If you are looking to buy here for a continuation there to the upside, wait for price to show you buy continuation structure, and then you can look to trade those as your continuations there to the upside. So these are your 15-minute setups. Essentially, these are all my setups that I look to trade. This is my probability scale, if you like, of opportunities that I'm looking for. These are how I see high probability and low probability locations on the chart as well. And then it's all about the entry. Of course, you can learn our entries inside NJAT. These are already set out, all the processes, all the ways of entering, all the rules for entering. So you don't have to go through years of working it out for yourself. You can just go straight into a process that you already know works, or up to you, go through the years of trial and error to understand what your entry can look like. But everything that we use to understand the higher time frame is the RAMC model. Of course, we're looking at things like structure. Location is what we're looking for here on the charts, high probability and low probability locations, which is the green and red areas. So once you understand trade location is when you can start to get into higher probability trades, and you can start to understand where you're taking your trades on the chart as well. Really important. Then also we've got things like strong rejections, fractals, aggression and speed, stretch legs, and of course, how do we break above the highs and lows, which is also really important. These are all things that you're going to learn in the price action course as well. But now let's get into some actual chart examples and some actual trades, and we can use our probability scale and location scale to start to understand where our trades are being taken. So now if we just go back to the trades that we looked at earlier, right, and we just think about where these trades are being taken. So when we start to think about market structure here, we have our A to B continuation structure. This is our trending market. Price has just broken below this low, so we're on a breakout now. So now if we're taking this trade on the breakout here to the downside, just remember this is low probability trading here to the downside because we are trading at the breakout looking for continuation there to the downside. Overall, we want to be trading before the breakout, not at the breakout when it's happened, looking to trade that as a continuation to the downside. So this is why this is a low probability trade. So any trades that you take around this area here at the breakout are going to be considered low probability trading. So if you have a look back at all of the trades that you've taken, hopefully you guys are journaling all the trades that you have so you can see what are high probability and low probability. If you apply on the probability scale and setups that we just went through, that's where you can understand if this is high probability or low probability that you're taking. Also, this is coming from a higher time frame mitigation. So if we just go to, let's say, a higher time frame and see where this is reacted from, let's say a daily chart here, and we just go over to the left-hand side of the chart, we can see that we have a very large sideways range here in the markets, followed by initiation there to the downside. If you don't know how to read a sideways range, it's a sideways ranging price action, price contained between a low and a high before we break out there to the downside. That is considered a sideways ranging market, which is the first part of the RAMC model that we're always looking for on the left-hand side of the charts, price that's already printed. Then when price pulls back into this location here in the future, into this sideways range area, this is where we look for our mitigation and continuations away from this location. Exactly what I just went through on the setups. Again, higher time frame analysis. This is what we use in RAMC4. Then we look for our lower time frame setup, which is our continuations away from this higher time frame mitigation. And then once we have direction on our side, once we have structure on our side, and we know that we're looking in high probability locations for our trades, that's where we can go to step 3, which is the entry. This is why I always say entry is the icing on the cake to a great high probability trading idea. So let's just drag that across and let's go to a lower time frame. So cool, so we're back to our setups now. So this is why we're looking for bearish continuation structure here. And just because obviously we can see that we're at a bearish mitigation, which is this whole red area, it doesn't just mean straight away that we can just look to sell the market, right? We still have to think about where's high probability and where's low probability on the charts, because then we can have 2 timeframes that are showing us high probability setups. So this is why this is a low probability setup. We traded it at the breakout. This is a lower probability setup overall. So now we can understand that. Now we can understand why we lost that trade. And now we can improve our trading by understanding where high probability and low probability is on the charts. Now, what's the difference between that trade and this trade that we're about to place here? Now, this trade is placed inside the A to B, right? This is a A to B movement here on the charts. This trade is placed inside the A to B. It's not placed at the breakout here or the breakout here. It's placed inside the range, right? Looking for that continuation there to the downside. This is my setup here on the 15-minute charts as well, the fractal high here to the downside, and then enter on the close of the candle, looking for that continuation to the downside. Now, because this has happened inside the range, price is very likely to target either this low or this high inside the range. So if we're entering inside the range and we're looking for bearish continuation, then price is likely to target the low, so we can get a better entry and a better stop, looking for that continuation there to the downside. This makes this trade a high probability trade because we are in continuation structure and we've entered inside the A to B range. So let's move on to the next trade here. Again, we're still looking for sells because the higher time frame is still bearish to us, which means we're looking for sell setups, right? So let's look at the structure coming into this here. A to B, we've pulled back here as well. Then we've run above this previous high, haven't extended, and now we're seeing a move in the opposite direction. So this is our sell setup in the market. Now, because we've broken above this high here, this is our A to B here to the upside. We've broken above this previous high. Now, because we are looking for sells, we've run above that high, and that gives us an opportunity to play the opposite direction within the market to trade a high probability continuation there to the downside. Some people may call this a liquidity grab. It's only a liquidity grab because we've run above the high, we haven't extended, and because the higher time frame direction is looking for sells. That makes this a high probability trade because now we're looking for continuations away from this location. We've reacted from a previous sideways range here as well. Range, initiation, mitigation, continuation. And we also have our setup, run above that high here and don't extend. So now this is our high probability continuations. Remember, as we went through before, any continuations here down into the low here or before the breakout are going to be high probability trades there to the downside. This is how you can really easily start to understand high probability trade locations on the chart alongside the higher time frame and the setup. It's all of these working together that makes this a high probability trade. So as we see here, run above that high, we didn't extend. Any bearish continuations here to the downside. If you're trading on the 1 minute chart, any continuations here to the downside are going to be high probability. And then as soon as price breaks this low, or before we break this low, do not look to trade these, because again, you're very likely to get a pullback there to the upside. So this is what makes this a high probability trade there to the downside. Then we move on to the next one. Of course, you're probably already understanding why this is low probability now. We've broken the low, so we've had a breakout there to the downside, and you're selling the breakout, right? These are low probability trades. The reason these are low probability trades is because when price breaks a high or a low in the market, let's say this is a high here, there's three things that are going to happen. First of all, we target the previous low down here. That's the first thing. The second thing is we pull back before we continue, or the third thing is we see continuation. So that means that if you're trading the breakout, you have a 33% chance of that trade playing out there to the upside. Now, that also means that you would have to have an open stop, because if price does decide to pull back before continuing there to the upside, that's going to lower that 33% even lower as well. So this is why you want to be putting yourselves on the side of high probability, which is where price is more likely to move in the opposite direction, or more likely to move in your direction. So if, for example, you trade sells when price runs above a high and you trade the opposite direction, you're putting yourself on the side of 66% probability that price is going to move in your overall direction. Now, if you have a stop loss, which is also in a safe location in that direction as well, then you've just increased the score even more on that trade to play out. This is why I trade with setups, because it's based on probability and it's based on the numbers in your favor. And that's what creates high probability trading and high probability setups. So this is low probability. If you want to look at it in numbers, this is more like a 20 to 30% probability of playing out at the breakout, probably even less at breakouts, just because the amount of breakouts that don't continue. And even if it does continue on a breakout and you've got, let's say, a 30 pip take profit or a 20 pip take profit, price may just continue that breakout and then start a pullback here in the future. So you might not even hit take profit on that trade. So even if it does work out in your favor, you're still not going to hit take profit the majority of the time. This is what makes it such a low probability trade. It's better to get involved after you see price run a high into a mitigation and then play that new direction in the market in this area that we have here. Now, that is a concept, and probably one of the most important concepts that you can learn in trading when it comes to location. And that is how to see where your trades are being located and trades are being placed in the market, so that you can improve your trading overall, and you can look to sell continuations in good locations, and you can stay out of trades in those low probability locations. This will massively help you to improve your trading. And this is one of the most important concepts that we have inside NJAT to understand trading location as well. Hope you guys enjoyed the video. Make sure you leave a comment down below if this has helped you. If you want to find out more about how we trade these markets and you want to get access to our price action course, our trading strategy entries, our daily mentoring as well, and get access to potentially being mentored by me and Chuck's one-to-one in our diamond program, which we will pick you as long as you go through the roadmap and you execute everything in the roadmap perfectly. You will enter into our diamond mentorship, which is one-to-ones with me and Chuck's completely free, and will make you a consistently profitable trader. Then visit our website at notjustatrade.com. If you want to find out more about the RAMC model and how we trade these markets as well and get our A+ setups, go down into the description and download our RAMC PDF completely free. Make sure you like the video, and we'll catch you guys on the next one.